The Fear and Greed Index is a sentiment gauge designed to show whether investors are acting more emotionally cautious or aggressively risk seeking. In both stocks and crypto, it takes a wide range of market behavior and it compresses it into a single reading from 0 to 100. Lower numbers suggest fear, higher numbers suggest greed. And the core idea is simple. When markets get too fearful, assets may be oversold. When they get too greedy, they may be overheated. Please subscribe. In the stock market, the best known version is CNN's Fear and Greed Index. It is built from 7 inputs tied to the U.S. equity market: stock price momentum, stock price strength, stock price breadth, put and call options activity, junk bond demand, market volatility, and safe haven demand. In other words, it's not just asking whether the S&P 500 is up and down. It's looking at whether traders are chasing risk, hiding in safer assets, buying protection through options, or showing broad participation across the stock market. The result is a broader mood reading for traditional finance. Crypto uses a similar concept, but the data sources are different because the market structure is different. For example, Alternative.me's Crypto and Fear and Greed Index focuses mainly on Bitcoin sentiment and pulls from several weighted inputs: volatility, market momentum and volume, social media activity, surveys, Bitcoin dominance, and Google Trends data. Their methodology currently notes that surveys are paused, but the model still emphasizes price swings, trading behavior, online attention, and whether money is rotating into or out of Bitcoin relative to the broader crypto market. That leads to the biggest difference between the two indexes. The stock version leans more heavily on institutional style signals like junk bond spreads, options positioning, and safe haven flows. The crypto version leans more on retail driven and internet native behavior such as social engagement, search trends, volatility spikes, and Bitcoin dominance. Put simply, the stock index is measuring sentiment through the plummeting of Wall Street, while the crypto index is measuring sentiment through price action, trading intensity, and online crowd behavior. Neither index should be treated like a crystal ball. They are better understood as temperature checks. They help explain the emotional backdrop of the market, but they do not replace technical analysis, fundamentals, or context. Used well, they can help investors recognize when the crowd may be leaning too far into one direction. One more note: when the meter is low and in the fearful territory, many people see this as a buying opportunity because the prices are generally lower here as well. Not financial advice. Please do your own research. I'm Jacob Raven, and thanks for watching.